Dear viewers, many thanks for joining this webinar. My name is Daniel Nydegger. I'm a relationship manager at Petiole Asset Management AG here in Zurich, and I have the honor today to guide you through this webinar. We hope you had a very pleasant festive season and you were able to recharge your batteries. First of all, I want to quickly introduce Petiole. Petiole Asset Management AG is an independent Swiss-based FINMA licensed asset manager with over 18 years of experience and track record in private markets, and the manages approximately 2.1 billion US dollars. We have offices here in Zurich. This is the main office, and also offices in New York and Hong Kong. In October 2022, we launched our newly digital platform to democratize the access to private markets for qualified investor with a much lower entry minimum of 150,000 US dollars. It is almost mid-January again, and we at Petiole would like to take this opportunity to speak about the market outlook 2023 and how investors may seize opportunities in private markets. For this, I want to welcome David Darst, our Senior Advisor and Strategist, and Naji Nehme, our Chief Investment Officer of Petiole Asset Management AG. Hi, everyone. Hi, both. Before we start, I just want to mention that you can raise questions during the webinar. I think on the top or low right, you find a window. We're trying to answer these during the webinar or at the end. Surely you can reach out to us anytime after the call via the official channels. 2022 was a rough and tough, volatile year for everyone. Rising inflation, hawkish central banks, geopolitical tensions, those topics were omnipresent and still are. And they especially influenced all markets substantially. David, the last time we saw inflation on these levels was approximately in the 70s, 80s. You lived through that time, and I wanted to ask you how this was from day to day back then. Do you see any similarities?
Yes, Daniel, thank you very much. I was actually in Zurich, as you know, from 1975 to 1981. So right in the middle of that, the dollar was going down, the oil prices were going up, interest rates were going up, inflation was going up. So many of those things were the exact same thing. We had the conclusion of the Vietnam War conflict. That was part of the reason for the increase in inflation, a secondary reason. There was a lot of bearishness around, Daniel. So there was some similarities. I would say it was a time of pessimism. There was a geopolitical. Remember, Europe was under communism back then. There was the worries that there was going to be a conflict. World War III was going to begin. I actually received a letter from the Swiss government telling me to prepare in case we had World War III. So we had a lot of anxiety, a lot of fear back then. Let me just say, on April the 4th, 1975, right in the middle of this, two young men, started a company in Albuquerque, New Mexico, and they called it Microsoft. And so here we have, in the midst of this, there's always opportunity. I would say one big difference is today we have much greater selection and much greater access to private equity, private credit, and private real estate. Back then, it was all just the liquid markets. There was not this access and opportunity opening up. I don't even think KKR was founded as of 1970, early 1970. So these are some of the things. August of 1979, Jimmy Carter appointed Paul Volcker to be the chairman of the Fed, and he raised interest rates. We were sitting in Zurich watching the election in November of 1980. The interest rate, short-term interest rates, was 21%. And our mortgage that me and my wife got, 18%. So a big difference. I think the world is much more globalized. China, Mao Zedong was still living at that time. China has come onto the stage. So these are some of the big changes and some of the big differences. But markets and people don't change. We have fear. We have greed. There was a lot of fear then, and it was creating great investment opportunities for people who were able to maintain flexibility, balance, and perspective, Daniel.
Thanks, very, very interested. So, David, what would you identify today as the three most important topics and trends to watch, especially in 2023?
Daniel, thank you. I think at the top of the list is, of course, the earnings and also the strength of the China recovery. So that's number one. Both of those relate to the economy. Is the economy going to be falling into a mild recession, or a deeper recession, or a hard landing, or a soft landing? So that's number one. And what will that mean for earnings? Right now, the estimate is for earnings. The latest estimate I checked last night is for earnings to go up for the S&P 500 by about 4 to 4.5% for this year. You know, it's our feeling that many times these estimates are a bit too optimistic and too bullish. And that's for 2023. 2022 is also supposed to be about 4.5%, the complete year. Our number two is monetary policy, Daniel. And there is the Fed going to stop raising interest rates when they can declare victory over inflation. They had a lot of commentary this week that they're not going to do that throughout this year. So that's the second thing. Are interest rates going to stay at this 4.25%, 4.5%, and go up to 5%, and then slowly come down in 2024? And the last thing to watch very carefully this year is, of course, politics and geopolitics. Politics in the United States, we have a very narrow difference between the Republicans and the Democrats, and there's likely to be a big fight about raising the debt ceiling later this year. And that would be that could be very nervous and nerve-wracking, causing a lot of volatility in the markets, as it did back in 2011. It caused the Standard & Poor's to lower the debt rating of the United States of America from AAA to AA plus on August the 11th, August the 5th, 2011. That's the politics part. So get ready for, I think, some. If you think it was crazy, this whole election of a House. The House Majority Leader of the guy from California, Ryan, if you think that was crazy, this is just a warm up for what could happen later this year. Geopolitics is, of course, always a wild card. What could happen in the Ukraine-Russia conflict? What could happen in Taiwan? I think you've got to watch out for cyber attacks. Don't forget that you had on September 26th last year, a mystery. Nord Stream 1 and Nord Stream 2 pipelines under the North Sea, under the Baltic, all of a sudden exploded. Still no one knows who did that. So that's in the geopolitics. I think you need to be prepared for surprises, pipelines, undersea cables, and satellites. If you have one side or the other losing in this conflict, I think you could see attacks on global infrastructure. So that's, I think, something to be mentally prepared to take advantage of it. I would say to all investors, when we have these unsettled conditions, you ride the tiger. Don't let the tiger ride you.
Thanks, David, for those inputs. So Naji, again to you, and also with the same question. Would you like to add anything? How do you see it? What trends do you see for 2023?
Thanks, Daniel. Yeah, on my side, I'm watching a few things. So one is the health of the U.S. consumer. I think, despite the market volatility that we have seen in 2022, the U.S. consumer have been a very healthy consumer. You look at the data at the end of the year, whether it is Black Friday or Cyber Monday, and we had record years compared to previous year. And of course, this was related to all the parachute money that was given during COVID. Consumer have saved a lot of money, went and, bought things related to durable goods, whether it is, a used car or fixing their house, decoration, all of that. Then they moved to services. The last year, what we have seen is really good consumer behavior from a service point of view. The economy have reopened, so they were traveling a bit more, maybe domestically still, but there was this health of the US consumer. So despite the inflation that we have been seeing, I think we haven't seen the pain yet on the US consumer, especially. And that's something that I am watching a bit more carefully this year, whether the US consumer is going to feel the pain, they're going to reduce their spending. And we all know that, a US economy is 70% consumption. So if you're going to look at one aspect, I would consider the US consumer here. The second thing is related to inflation. Of course, we haven't, moved out of that high inflationary environment, and we can discuss this at a later stage, what it means for portfolios. But for me, I'm looking at the change of rate of inflation. If we are, going from a 7.7% to 6%, that change of rate might be very positive for the market. I think the direction of the inflation is not just the level of inflation, is also the direction of that inflation. So that's something as well that I am monitoring. And the third thing is volatility. I think we have seen huge volatility in 2022, and I don't think that we're out of that market environment in 2023. There are still a lot of question marks. So David have highlighted many of them. And it is how to take advantage of that volatility, because 2022 was volatile, but was directionally volatile. Yeah, you would have to be avoiding the market, and for a long time. I think this time around we might see bounce of volatility, and therefore you need to be much more nimble, agile in your execution strategy when it comes to investments. And then how to really take advantage of that volatility. So these are the three things I'm looking for, Daniel, is the consumer, direction of inflation, and volatility in 2023, the nature of that volatility compared to 22.
Thank you very much, Naji. Question to you, David. You mentioned now the macro environment, the trends. So what do you see as a main risk, especially regarding different asset classes, fixed income, equity, and also private markets?
Daniel, that's a great question. I think we need to keep in mind where we are in a longer term perspective, longer term context. As you know, the 1970s were really the decade of oil. The 1980s were the great decade for Japan. The 1990s were the decade of the advent of the internet. We're getting ready for smartphones, Nokia, the BlackBerry. So that was the 1990s, the telecom, media, tech, TMT, boom. The 2000s were really the decade of China, 2000 to 2010. 2010 to 2020, you could say this was the decade of technology. This was Facebook, Meta. This was Google. Okay, this was Apple. This was Amazon. This decade that we're only two years into this decade, Daniel, we think is going to be a decade of much more challenging environment. We have never, ever had such enormous monetary and fiscal stimulus that we had in response to the pandemic, to the COVID pandemic globally. And secondly, we've never had debt levels that we have today. The world GDP is approximately $100 trillion, 100 trillion. The world debt is 300 trillion. So it's 300% of the world GDP, which is historically very, very high. So we are saying to people, we may be entering some periods of deglobalization and decoupling. Therefore, as we look ahead, risks, of course, could come from the shadow banking system. Last year, we had this British pension fund kerfuffle, whatever you want to call it, this crisis, that people were involved in strategies that no one really had much clarity about. There was very little understanding of it. The clearing houses, there's an analysis being done right now of the clearing houses, the exchanges. The failure of FTX, that's cryptocurrency exchange, that's totally different from these others. But the clearing houses for options, for futures, for stocks, and for fixed income securities. They are being looked at by the Bank for International Settlements and a consortium of central bankers. And finally, hedge funds. Our hedge funds, they're part of this a broader financial system, not just the banks and the investment banks, but they're part of this broader investment system. I've been thinking about it. Naji and I have been involved in weekly and daily conversations. One of the things that's been very strange to me, volatility right now is very, very low. There's a complacency. There's a calm right now. The VIX index. And then you have something, believe it or not, Daniel, you have the VVIX, which is the volatility of the VIX index. Can you believe that we have that now? This VIX index and the VVIX index, as well as credit spreads. And Naji's been an expert on this and has educated me for years in and years out, for many years. The credit spreads are shockingly low right now. If we're going to have a hard landing or a medium landing, these credit spreads being so low are something that is mystifying me. I think we have, as we look ahead, and I mentioned a moment ago, risks to the currency, in addition to the risks to the infrastructure. The currency is the infrastructure of the global economy and the global financial system. The dollar was king last year, up until about halfway through, and now the dollar has come down a little bit. I think Europe has had a very strong performance in the last 6-8 weeks. It's just been amazing to me. It's the leading equity market. So we have to look for places where there is value has been created by some of these conditions that we have. Where is there? It's price versus value. This is the challenge that all of us face in our work, in our profession as investors. Price versus value. This has been what's the secret to Warren Buffett and Charlie Munger, their tremendous record over 50 years. The big risk for me that I'm looking at day in and day out is earnings. Are earnings going to fall more than expected? This week on Friday, Jamie Dimon of JP Morgan, Brian Moynihan of Bank America, many of them, Wells Fargo, they will all be giving earnings report for the fourth quarter, but also very importantly, earnings outlook for 2023. So we need to pay attention. What do they say? And what does the press and the media respond to what they say? What do investors? Next Tuesday is Goldman Sachs, Morgan Stanley. So you'll have the investment banks next week. You have the big money center banks this Friday. That's very, very important as we look ahead. You had some of these tech stocks have been killed last year. Microsoft was down 29%. Amazon was down 50%. Meta was down 64%. And Google, Alphabet, was down 39%. Is it time? I think we have to wait and be very, very patient in times like this. This is no time to move. You need to take time to deliberate, consider, have some liquidity, and be prepared to opportunistically put that to work in liquid markets. And Naji here is an expert in the private markets, private equity, private credit, private real estate.
Thanks, David, for your inputs. Naji, so we talked now about risk, and everyone is talking about also about recession and how deep the recession will go if there is one. So, for example, will the US enter a recession? And how do you see differences from recessions before? How you would, or what do you expect, and describe the environment?
Yeah, we like to frame recession in 3 categories, Daniel. I think that was a study by Goldman Sachs where they said there are 3 types of recession. There's one, we call it a structural recession. Another one, we call it a cyclical recession. And the last one is an event-driven recession. That's how they broke down recessions. And structural recession means, you have financial bubbles. The dot-com bubble is a structural one. The GFC was a structural one. A cyclical recession is one where you get the recession through interest rate, hike. and that is the cyclical recession. And an event-driven is, something like 9/11, for example, is an event-driven recession, and it's a shock, oil shock in 1990. And then each one of those, if you break it down, it has a certain implications on markets. Definitely the worst recession in terms of market has been the structural recession, the GFC, where equity market went down 55%. We think we're going to be in that cyclical recession if we follow the historical path. That cyclical recession, equity markets dropped around 30%. In the peak of the market until the trough in 2022, we went down around 27%. Now, it doesn't mean that we're at the low. I think one of the elements that the way we have been down, it has been more price to earning multiple compression. So we went from a very expensive valuation on the markets to now more normalized valuation. But what David mentioned is the earnings. What he's looking for is earnings, because earnings have not yet moderated. He just mentioned that. And if you see a moderation of the income with the current valuation level, we expect the market to have further market correction. I think if you tie that recession with the current conditions that we went into the recession, we talked about it. Consumer has been healthy. Unemployment is low. A lot of stimulus have been put in the system. So yes, the view that we've taken last year is that we're going to face a recession. It's going to be a cyclical recession, a bit milder recession because of that strength of the consumer and the economy coming into the recession. But that's economy, Daniel. And, being market participant, David and I, we know that economies doesn't necessarily follow markets. Yeah, so there is a difference between the economies and the market. Does this mean if we see a mild recession that we're not going to see volatility? Does this mean if we see a recession, we're not going to see surprises like the LDI, the UK pension fund? Who thought that this will come up? So these are surprises that you will get from this current market condition. And I think the major risk that today, at least I am considering, is that we moved from that phase of a very stimulative, accommodative policies, very low interest rate environment, and now we're moving to something that we've lived since the last years, and now we're moving to a phase of a higher interest rate environment, positive carry. Think about moving from a negative in Europe to positive in Europe, and that is a new environment that's going to stay there, and that is the biggest on companies that have had a lot of debt on their balance sheets. Risks on valuations that have been elevated and inflated due to low interest rate environment, risk on duration of assets. A lot of think of the technology stocks that David mentioned that have been, being valued based on very future earnings. I think that is the new environment that investors should really think about, is an environment where we're going to be in a positive interest rate environment for a while, and customize portfolios that will benefit and protect investors against that change, because now we're at the inflection point. We're not there yet. The Fed is continuing its interest rate. The ECB is continuing its interest rate, and the ECB is quite late compared to the Fed. So that we are not there yet in terms of interest rate peak, and therefore we are in that inflection point. And that during inflection point is the most critical phase of portfolio construction. And that's where you want to be very careful on how you select the assets, how you want to maintain liquidity, and how do you construct defensive portfolios.
Daniel, may I just add one point there? I think Naji has made a very important point for investors to consider. And we are of the opinion at Petiole and the family office that we are unlikely to go back to the conditions of the previous decade. I think that's what was implicit in some of Naji's remarks. People, I think, have given very little attention and focus and awareness of the disruptive effects that we're maybe entering a new set of conditions going forward that we've had in the past. You're talking about China's reopening and the world's view and relationship with China. Same with Russia. You're talking about technology sanctions. You're talking about the weaponization of the dollar and the weaponization of oil during this past year. So these are things that I think are setting up a brand new set of conditions. We would remind everyone the Federal Reserve has two functions. One is to maintain price stability. Two is to maintain full employment, or employment conditions, keep them healthy. I think there's a new thing that we need to take awareness of. The Fed, one of its unstated roles is, I think, they're being looked to preserve asset price stability, and also a fourth one is to finance the federal government, which has had these huge deficits. So we need to prepare ourselves that we're not going into a replay as soon as listen to this, a brief and mild recession, a very small bear market, and no lasting change or damage to the markets and to the economies globally. We don't think so. We think, as we sit here, Naji and I and our team, as we sit here, we're thinking about how are these new conditions going to affect investing going forward. So thank you for letting me add that to what Naji was talking about.
Thanks, David, and thanks, Naji. So this brings you also to the next question, and also we talked about risk, about the environment, the trends. And now we want to focus also on the markets, especially. David, what opportunities do you see in the public market, on the public market side? You talked about liquidity, about opportunities specific, but do you see a change also in the environment, and what would you see as a good investment or a good diversification, especially in these markets?
Daniel, as you know, we've had low interest rates, we've had low inflation. We think we may be moving into a period of higher than interest rates than we used to have, and higher inflation as a normal condition. Doesn't necessarily mean hyperinflation or super high inflation, but we think we're so we need to find companies and industries and managers who can thrive and take advantage, can generate high return on equity, not through leverage, but through profitability and through revenue growth, that can generate a significant free cash flow. So we want companies that have flexibility. This gives us, Daniel, healthcare. Okay, this gives us financial stocks. We have a brilliant manager in New York. His team, Drago Kolev and John, his partner. They basically focus on nothing but banks and financials, and I think this is an area that we would be looking at. We have a tendency right now. I don't think the growth, the repricing of growth, as Naji just mentioned, with interest rates being higher, capitalization of income flows and terminal values is going to be lower. So we don't think the value versus growth repricing is over. Growth, you're going to love this. Growth fell 31% last year, and value fell 2% last year. And some of the parts of value, which would be the energy sector, the energy sector was up 55%. I would say on the energy sector, and many of our viewers globally maybe have already exposure to energy. It's a mystery to me. British Petroleum and Shell, they both sell for 5 times earnings. Exxon and Chevron sell for 10 to 11 times earnings. And they're all for global exploration and production giants. Okay, why is this? Now, Europe and the United Kingdom have been talking about a windfall profits tax. So it's related, I think, to taxation. The yields on these two last stocks, I think you want to be looking for, as you go forward, companies that can generate and be friendly to you by returning cash through dividends or through stock repurchases, or a combination of that. We like defensive sectors. Defensive includes healthcare. Defensive includes consumer staples. But be careful, consumer staples and utilities are highly valued right now because everyone wants some defensiveness, Daniel. Everyone wants some defensiveness. But you really want companies that I think, whether we have a mild recession or whether we have a deep recession, can outperform in circumstances like this. They can gain market share and they can maintain profitability. That's really what we're looking at in the liquid markets, Daniel.
Thanks, David. Nachi, this question goes to you, especially now we're here at the public side, and also what does this mean for the private side, for private markets, and especially what does this mean for a classic 60/40 portfolio this year? And the question is, how would you position your portfolio?
Yeah, it's interesting you mentioned the classic 60/40 because that classic 60/40 have had 15% drop last year. So I think a lot of investors have not benefited from this classic balance of equity and bonds last year. And if you think about inflation, and we think interest rates is going to remain high, but inflation also we don't think is going to go back to the 2%. If you look today at inflation and you look at wage growth, you look at food inflation, maybe energy is going to go down. But we looked at numbers and we think inflation is going to go down, but it's going to stabilize around levels that are higher than historical average. And if you correlate inflation with correlation between equity and bonds, as inflation is higher, the equity bond mix and correlation is going to be lower. So it's going to be higher, sorry. So a high inflation, high correlation between equity and bonds, which means a traditional 60/40 portfolio maybe is not going to, give you defense as much as historically it has given you. And that's why we think complementing that portfolio with private markets makes a lot of sense, because private market is going to diversify you against that volatility that's going to come from the high inflationary environment that we're going to be seeing and the high correlation between equity and bonds. Go ahead, David.
I was just going to ask you, Naji, and you have educated me for a long time on the topic of manager selection. When you get into the private sector, I think the difference between a top tier manager and a mediocre or below par manager gets to be wider and wider, in contrast to many parts of the liquid markets where the difference between a good bond manager and a bad bond manager is just very small, or even a stock manager might be like this. But when you get into the private markets, and a couple of the key criteria that you focus on in selection of managers in the private markets.
Yes, I think the most important one is how does the manager create value in its underlying portfolio companies? Because the difference here is you have a certain role of activism in private equity. You're going to buy a company and you need to transform that company, whether through digitization or through platform acquisition, M&A, and so on and so forth. So what we are looking for, David, especially in today's environment, is the driver of value that the sponsor or a manager is able to do. Because if you look at the track record, I can tell you a manager have delivered 2.5 times multiple of capital over a historical time. But that historical time, that it has been a historical time where price to earning multiples have increased. So even if I do nothing to earnings, I can buy as a manager, something at 10 times earnings and sell it at 15 times earnings because the market lifted all boats. So, and if you look at one of the statistics I like to share with you is if you look at the exits in the last 6 years, 60% of the revenue drivers have been price to earning multiple expansion. And 40% have been on the private equity side, and 40% has been through revenue or earning growth expansion. And today, internally, we take a private equity sponsor or a private equity transaction, and we say we're not going to make money on any multiple expansion, and we want to see that the driver of value is margin expansion or revenue expansion. And especially now, like you have mentioned, you want to be defensive. So we're looking at transactions where the value driver of that transaction is going to be through margin expansion. And that margin expansion come through various ways that you can drive value, but that's really what we are focusing on today, from selecting our sponsors that have had a history and a track record of driving value through margin expansion. I hope that answered your question, David.
I think that says it in a nutshell. That's a very good, concise thing that investors, as they look to us and evaluate our ability to select managers, that you have honed in on what is their process? What is their model? What is their edge in creating value? I also loved what you just said, Naji, that so much of it was multiple expansion, which, as you know, we're in capital markets. So when interest rates are low, that lets the multiple expand. But when interest rates come up, and if they're going to stay up at a moderate level here, or maybe even a little bit above, then that's going to, the multiple part is not going to be anywhere near as important as the earnings, profitability, and revenue growth part, if I understand what you just said.
Yeah, and one more thing is the exit strategy. You want to think about how, I mean, you're buying private equity. In private equity, you're taking a view of 7 years, 5, 6, 7 years. So you want to see a path to exit. And where exit have been, you have ability to exit through IPO, as we know. You have the ability to exit through selling to another company, so it's strategic sale, or to another sponsor that is in his life cycle, he can deliver more value to the company. And last year at Petiole, we have exited the same amount that we exited the year before. So despite the difficult market environment, the exit have been very healthy for Petiole. And the reason is because we select sponsors that have the ability to exit in different routes and not just reliant on the IPO market being healthy, but can exit through strategic sales or exit by selling to other sponsors that want to create value. And that's an additional thing you want to look for when it comes to a sponsor selection. But I think strategically, when you think about it, you have private market, Daniel, private market benefit from illiquidity, because you're giving money for the long term. So the more there is illiquidity in the market, the more you're going to be paid to lock your capital long term. And in today's environment, we can talk about, if you like, later on, the opportunities that we are seeing. But in today's environment, especially, we're seeing a lot of still illiquidity in the market. And therefore, the premium that we can get in doing private market transaction is higher than the average. You combine this with the high correlation between equity and bonds due to high inflation environment, and you have an environment what is a very positive environment for private markets in the near future, and also in the medium term, because inflation is going to remain high in our view in the medium term as well.
Thanks, Naji, for this input. This brings us also to the next question about what is going on in the CEO office and about Petiole. And as you may already know, we offer 3 main programs. One program is the Capital Growth Program, which has main exposure to private equity via direct investments and co-investments. Also the Capital Yield Program, which should provide regular income through investments in real estate debt, real estate equity, and on. And the third program is the Global Credit, which actually seeks opportunities in the debt market and provides also certain liquidity to the investor. So my question, or our question here is, what opportunities are you currently looking at Petiole, and how do you plan to play these, especially in the upcoming months and until the end of the year?
Yeah. So Daniel, I think we have been very, very busy, I must say, since last year, mid of last year, busy in looking at the opportunities, because the market reopened in a way of valuation have moderated, and that also the illiquidity create opportunities. So I give you a few examples of things that we have done. In the capital growth, as you mentioned, is a capital appreciation objective, mainly private equity co-investments. And if you look at historically, private equity returns, let's say, have averaged around 12%, and the returns post-recession have averaged 18%. So if you look at 2 years post-recession, a private equity vintage have averaged 18%. So in an environment that we are in today, which we discussed going into recession, then you want to be in private equity because valuation have moderated, and we expect private equity to deliver higher than historical average in those vintage years. So we're looking at more and more private equity transactions, but not at any price and not any business model. I think we discussed having a defensive balance sheet, leverage is not going to be in your favor, and having a value driver that is very much around earnings and less about price to earning multiple expansion or even revenue growth. So private equity is one where we're playing it. I think the secondary market is going to come back as well, having investor that maybe have overcommitted to the asset class over the last years. They might want to rebalance their portfolios. I think there's an opportunity for secondaries, and that's another area that we are adding in our portfolio. And the second one is the capital yield. That's the income play. That's where we diversify portfolio and co-investment that generate a current cash pay to investors. We are playing it through provider of liquidity, and we are a solution provider when it comes to liquidity. Think about the banks retrenching in this environment from lending. You as a private market players, you can replace the bank, but earn a much higher fee. So we're looking at financing businesses that are merging. For example, that's a first lien or second lien. We're financing real estate development and prime cities as well, that we think are prime cities are a long-term trend, sustainable assets. So we are financing those. And we are also financing structured credit, where you have to provide certain customization to the investor, all through a diversified portfolio. And these rates, given that, the rates have expanded, I think today you're getting a nice premium by being a liquidity provider and in a market that is relatively illiquid, and we're able to get a nice premium on top of the public market yields. And the last portfolio that we run is more a dislocation portfolio. That is where, for example, David mentioned the financial strategy, buying US community banks. We started doing this last year. That's a track record we have for the past 12 years. That is one that we are doing. We are buying discounted assets on the public side, because we can also, through the dislocation that we are seeing, construct portfolios that are publicly oriented. You have to assume certain illiquidity. So we're not buying to sell and trade these assets. We're buying them for a 2 to 3 year terms hold, but we're buying them on the public market, where we're seeing that we're getting paid almost like a private markets portfolio, but being on a public market. So we're also working on that bucket of the portfolio that is more dislocation, tilted a bit more toward the public market dislocation that we are seeing.
Thanks, Naji, for those insights. And I want to check questions also in regard of time. Give you 1 second. There is actually none. That's also good time-wise. So I have a closing question to you, David. You've been in the industry for many years, and so on, or another crisis. And especially for younger people, younger investors, what advice would you give to navigate through these demanding times, and how to behave, especially?
Daniel, I would like to thank you for your generosity.
So maybe then address this question to you, Naji. Otherwise, or David comes up, what would you advise to younger investors, especially in these trying times?
Yeah, I would say it's mainly for investor generally. I would say in these times, you want to be quite nimble, agile in your investment strategy. I think that's number one. You want to have ability to commit capital, because opportunities will come this year. So you want to be able to commit capital, have the ability, the liquidity to commit capital, because there will be quite a lot of opportunities. And always think about a portfolio context. This is the time where you need to diversify. It's not a time where you need to make bets. I think it's a difficult time. And when you have diversification, that's the only free lunch we learn in our business. So, and that diversification, unfortunately, did not work on the public side. So I would say, consider the private market as a diversification tool, because last year, maybe balanced portfolios have been down 15%, and private market portfolios have been down 5%. And that's the room of diversification. At the same time, if you are an investor today and you are quite nimble and agile, you can be a provider of liquidity. And in periods like these, you can secure capital that will pay you for the next 5 years, even if the markets come back. So I think the ability to be nimble, agile, diversify your portfolio in private markets as well as public markets, I think is the advice I would give for this year.
Thank you very much, Naji, for your advice, and also for your time participating. And also David, maybe David can't hear us. I also want to thank the viewers, and if you have any question, reach out to us via the official channels or public channels, and also check out our website, our offering, and also the digital platform, which gives you an insight about what we do and how especially we offer those solutions to our clients. And with this, I want to close this webinar and wish you very, very good and great start into the new year. And that's it. Thank you very much. Bye, everyone.